Welcome to this session of Physical Academy tutorial on capital structure decision. In this lecture, I will examine capital gearing. If you are coming across my lecture for the first time, please like the video and also share it with others. If you are a returning subscriber, thank you for being part of this channel. Capital structure refers to the mixture of equity and debt finance used by the company to finance its assets. The measure of equity and debt finance used by the company to finance its assets. Therefore, the composition of equity and debt finance, that is called capital structure. Capital structure. And when a company is financed with the composition of equity and debt, such a company is said to have been geared. So that is what we mean by gearing. That is, a company is geared if it is financed with the measure of equity and debt. That is, a company that has the composition of both the equity and debt finance. Such a company is said to have been geared. So, gearing refers to the proportion of debt and equity in capital structure. The proportion of debt and equity in capital structure, that is said to be the gearing. Therefore, what are equity? Equity is the proportion of the company that is financed by the ordinary shareholders. The proportion of equity, the proportion of the company that is financed with the ordinary shareholders, the proportion of the company that is financed with ordinary share capital, that is said to be equity. That portion of the capital of the company that are not debt capital, that portion is said to be equity capital. Therefore, the proportion of the company that is financed by the ordinary shareholders, that proportion is said to be the equity. Now, the second one is debt or prior charge capital. Prior charge capital. PCC. Prior charge capital. PCC. This is the capital that has to be serviced before equity capital receive any returns. So it means they will be serviced, they will be settled before the equity capital holders can receive anything as a returns. So in the event of liquidation, the prior charge capital will be settled ahead of the ordinary shareholders. They normally receive their settlement prior to ordinary shareholders. Their settlement have to be met. Their own claims have to be met. Their claim have to be met before ordinary shareholders will receive any returns. Examples of prior charge capital include the preference shares, preference share capital. Then we also have long-term liabilities. Long-term liabilities. So examples of long-term liability that falls within these categories include the loan notes or debenture. So debenture or bonds, any of these terms may be used. They are the same, loan notes or debenture or bonds. So they are the examples of prior charge capital we are talking about. Formula for calculating capital gearing. Formula for calculating capital gearing. Number one, we have the equity to debt. Equity to debt ratio. I've told you the debts are the prior charge capital. The debt are prior charge capital, and I've told you it includes the preference shares, It will also include the loan notes or debenture or bonds. So equity slash debt ratio, that is the ratio of equity to prior charge capital times 100/1. That is the formula number one. Number two, we have the debt to equity ratio. Debt to equity ratio, and that will be debt over equity. The debt, I've told you the debt are the prior charge capital, that is debt. Prior charge capital, that is debt. So we can have prior charge capital over equity times 100/1. Number three, we have equity to capital employed. The ratio of equity to capital employed. Equity to capital employed, that will be the ratio of equity over capital employed times 100/1. Where capital employed equals to equity plus prior charge capital. Equity plus prior charge capital equals to capital employed. Formula number 4, we have debt to capital employed. Debt to capital employed. Wherever you have prior charge capital, you can always use debt. So debt to capital employed, that will be prior charge capital over capital employed times 100/1. Or I've told you, you can put debt in place of prior charge capital. That means you have debt over capital employed. Times 100/1. Why this one? We have equity over capital employed. Then the number 2 formula is, since number 2 you have prior charge capital over equity, so it can be written as debt over equity times 100/1. Then the number 1 formula, where you have equity over prior charge capital, you can write it as equity over debt times 100/1. You should know that your debts are the prior charge capital, and I've told you the prior charge capital include the preference shares, the loan notes or debentures or bonds. So this have to be summed up to give you the prior charge capital or debt. Now let's take question as work example. Keep watching. Example: One Chance PLC's extract from its statement of financial position as at 31st December 2025. Amount is in naira. We have ordinary shares of 50 kobo each, 1 million naira. Reserves of 1.4 million naira. 14% preference shares of 1 naira each, 1 million naira. 15% unsecured loan stock, 600,000 naira. Total long-term funds, 4 million naira. The ordinary shares are currently quoted at 5 naira each. The loan stock is trading at 75 naira per 100 naira nominal, and the preference shares at 0.60 naira each required. Calculate the gearing ratio for One Chance PLC using A, book values, B, market values. This question is obtained from ICAN study test, financial management. Solution: The name of the entity is One Chance PLC. One Chance PLC. So you have to compute the gearing ratio for One Chance PLC using the book value. So gearing ratio, the formula to use is debt to equity ratio. That is the formula you should always use whenever you have to calculate the gearing ratio. So always use debt to equity ratio formula. Debt to capital employed. That is the appropriate formula to always use. Ratio of debt to capital employed. Capital employed. This is the formula you should always use whenever you have to calculate the gearing ratio. If the formula is not specified. So to use other formulas I've given, I give you 4 formulas for calculating the gearing ratio. To use any of the other 3, then the question will specify that. So the requirements will capture the need for use of other formula. But whenever the examiner is silent as to the formula to use, if you have to compute the gearing ratio or financial gearing or capital gearing, always use the ratio of debt to equity, debt to capital employed. And I've told you that the capital employed will always be the equity plus prior charge capital. So that is what I've told you. Your debt is the prior charge capital, PCC, over capital employed. I said it will be equity plus prior charge capital. So times 100 over 1. So I've told you your prior charge capital will comprise your preference shares, the loan stocks, the debentures or bonds. So now, what are the prior charge capital based on the information provided in this question? So now go through the question. So reserves should be excluded. And one thing I also want you to bear in mind is that whenever you have to compute the gearing ratio, if information about the market value are given, always use the market value. Unless otherwise stated, market value should always be used whenever you want to compute the gearing ratio. Now, the prior charge capital comprises the 14% preference shares and the 15% loan stocks. These are the prior charge capital we have in the question. So we have 14% preference share, and that amounted to 1 million naira. 1 million naira. Then 15% unsecured loan stock. 15% unsecured loan stock. So that amounted to 600,000 naira. By the time you sum up this, so our prior charge capital is total 1.6 million naira. So that is our prior charge capital. Now we also need equity. I've told you the market value should be used, but in the requirement A, you have to use the book values. That is why the prior charge capital I've computed is based on the book value. Then the equity that will also be computed, will also be at the book value, since the examiner asks you to use the book value based on the requirement A. So what are the total equity? So our equity comprises, so we have ordinary shares of 50 kobo each, 1 million. Ordinary share of 1 million. The par value is 50 kobo. So, and the reserves. The reserves is attributable to equity holders. Therefore, since book value is required to be used, so the reserves have to form part of the book value. So, but if market value is required, reserves will be excluded. So 1 million plus 1.4 million, that is total 2.4 million. The total equity is 2.4 million. Now that you have obtained the total equity, you therefore want to calculate the gearing ratio. So I've told you the gearing, I've given you the 2 formula here, that is the debt to capital employed. I've told you debt over capital employed or prior charge capital over capital employed. Gearing ratio, I said it is prior charge capital over capital employed. And I've told you the capital employed comprises equity plus prior charge capital. Equity plus prior charge capital, that will be the capital employed. The prior charge capital as calculated is 1.6 million naira. Now that the prior charge capital is total at 1.6 million, so you have 1.6 million naira over equity. And how much is our total equity? 2.4 million. 2.4 million. 2.4 million plus prior charge capital, which is 1.6 million. I've told you your capital employed should be equity plus prior charge capital. So we have 1.6 million over, this is total at 4 million times 100 over 1. So 1.6 million divided by 4 million times 100 over 1, that is 40%. Therefore, the gearing ratio equals to 40%. We have gearing ratio of 40%. Based on the requirement B, you have to use the market values. So you still want to calculate the gearing ratio. And I've told you the appropriate formula to always use whenever you want to calculate the gearing ratio is the ratio of debt to capital employed. And debt is the same as prior charge capital over capital employed. And capital employed should comprise of equity and debt. Equity plus prior charge capital will give you the capital employed. Therefore, since it is the market values you have to use, I've told you unless otherwise stated, market value should always be used. But this question requires us to use the book value in A and market value in B. That is why we have used the book value in the requirement A. But in this requirement B, we therefore want to use the market value. So you will need the market value of prior charge capital. Market value of prior charge capital. Remember, I've told you the prior charge capital comprises of the preference shares and the loan stocks or debenture. So we have 14% preference shares. So 14% preference shares. 14% preference shares. The book value is 1 million. And the market value per preference shares, we were told, and the preference shares at 0 naira 60 kobo each. So the market value per preference share is 0.60 naira. So 0.60 times the nominal value of the preference shares, which is 1 million. And that will give us times 1 million, that gives us 600,000 naira. So we have the market value of the preference shares to be 600,000 naira. Then we currently have 15% unsecured loan stock. 15% unsecured loan stock. So, and the book value amounted to 600,000 naira nominal. And the questions will find that the loan stock is trading at 75 naira per 100 naira nominal. So 75 per 100 naira nominal. That is 100 nominal value equal to 75 naira. So if the book value of the loan stock is 600,000 naira, therefore 75 over 100 times 600,000 will give you the market value of all the existing loan stock. 75 divided by 100 times 600,000. So we have that to be 450,000 naira. So the market value of the loan stock is 450,000 naira. If you sum up the preference shares, the market value of the preference shares and the loan stocks, then you have that to be 1,050,000 naira. So that is the market value of prior charge capital. So we have the market value of prior charge capital to be 1,050,000 naira. So aside the prior charge capital, we have the equity. Now, what is the market value of equity? market value of equity. So when calculating the market value of equity, the reserves should be ignored. You should ignore the reserves. So the number of ordinary shares and the nominal value is 1 million and the par value is 50 kobo. So number of ordinary shares, that will be 1 million nominal divided by the par value. So you have that to be 2 million ordinary shares. If the ordinary shares, the number of ordinary shares in EU is 2 million. And what is the market value of ordinary shares per share? The market value per share of ordinary shares. So you have the ordinary shares are currently quoted at 50 kobo, as 5 naira each. So the par value is 5 naira. I've told you reserves should be ignored. Reserves is not relevant when you are calculating the market value because the reserve is based on accounting derivative. It will derive from accounting, from the financial statement, the accumulation of profit that were not yet distributed as dividend. That gives you the reserves. So as a result of that, it is derived based on accounting concept. As a result of that, it does not involve cash. And the market value should be based solely on cash. Reserves is not a cash flows. Since reserves is not a cash flows, therefore, reserves should be ignored. So remember, you are interested in the market value. Please bear that in mind. And you were told the current shares are currently, the ordinary shares are currently quoted at 5 naira each. So each ordinary shares is sold at 5 naira. So the market value of ordinary shares, that will be 2 million shares times 5 naira. So that gives us 10 million naira. So that is the market value of the preference shares. Now that you've determined the market value of of ordinary shares to be 10 million naira and that of the preferred prior charge capital to be 1,50,000. Therefore, you can calculate the gearing ratio based on the market values. Gearing ratio, I said, is equal to prior charge capital, PCC, over capital employed. I've told you capital employed is equity plus prior charge capital times 100 over 1. So this is capital employed. And the market value of prior charge capital as calculated is 1,50,000 naira. So if that is 1,50,000, so you have the numerator to be 1,50,000, then divided by equity. The market value of equity as calculated is 10 million. So we have that to be 10 million. If the market value of equity is 10 million, therefore capital employed will be 10 million plus 1,50,000. Remember, the 1,50,000 is prior charge capital times 100 over 1. So we have 1,50,000 divided by 11 million. The addition of this is 11,50,000 times 100 over 1. So if you have 1,50,000 divided by 11,50,000 times 100, that gives us 9.5%. Therefore, gearing ratio by market value is 9.5%. This marks the end of the solution to this question. In my next video, I will examine the types of leverage and theory on capital structure. Please drop the love emoji, like the video, also share it with others. Thanks for watching ICAN. Bye.